Most investors stop thinking one step too early. They ask, is this company good? Will earnings grow? Is this news positive? Will this policy help the economy? Those are first-order questions, and first-order thinking is obvious. Linear, surface level. It asks, what happens next? Second-order thinking asks something different. And then what? And then what happens to expectations? And then what happens to positioning? And then what happens to liquidity? And then what happens when everyone else already believes the same thing? Markets do not price reality. They price expectations about reality. That is the key shift. Let's define it clearly. First-order thinking is simple cause and effect. Interest rates go down implies stocks go up. Company beats earnings implies stock rises. Inflation increases implies bonds fall. Sometimes that works, but in markets, outcomes depend on how reality compares to expectations. If everyone expects earnings to beat, and they do, price may fall. If everyone expects disaster and earnings are less bad, price may rise. Markets move on surprise relative to consensus. Second-order thinking forces you to ask, what is already priced in? Consider a simple example. A company announces a revolutionary product. First-order thinker, this is amazing. The stock will go up. Second-order thinker asks, how much optimism is already embedded in valuation? How much growth is required to justify this price? How crowded is this trade? If expectations are extreme, even good news may disappoint. Because price already assumed perfection. Howard Marks often speaks about this concept. He argues that superior investing requires second-level thinking. First-level thinkers see obvious trends. Second-level thinkers ask what others believe about those trends, because performance depends not on being correct about fundamentals, but on being less wrong than consensus. That's subtle, but powerful. Let's use macro as an example. Suppose inflation declines. First-order thinking says, good for stocks. But what if inflation declined because growth is collapsing? What if declining inflation increases recession probability? What if markets already priced in rate cuts? Now, the second-order consequences matter more than the first-order headline. Markets move not on data, they move on interpretation relative to expectation. Another classic example is crowded trades. When a strategy becomes popular, its first-order logic remains valid. Momentum works. Carry trades work. Volatility selling works. But second-order thinking asks, what happens if too many participants adopt this strategy? What happens to liquidity during stress? What happens if everyone tries to exit simultaneously? Crowding changes payoff structure. Edge decays when widely adopted. This is reflexivity. Participants influence outcomes by acting on beliefs. Beliefs alter price. Price alters belief. Belief alters positioning. Positioning alters risk. Eventually, small shocks create large unwinds. Second-order thinking also explains bubbles. First-order thinking during a bubble. Prices are rising because fundamentals are improving. Second-order thinking asks, are fundamentals improving because prices are rising? Rising asset prices increase collateral value. Increased collateral increases borrowing. Borrowing increases spending. Spending boosts reported fundamentals. Fundamentals justify higher prices. That is a feedback loop. Second-order thinkers recognize when price itself is driving fundamentals, and they know those loops eventually break. There is strong psychological resistance to second-order thinking because it requires uncertainty, tolerance, it requires questioning consensus, it requires humility, it requires admitting that obvious conclusions may already be priced, and most importantly, it requires independent thinking without needing to be different for ego. That balance is difficult. Let's talk about valuation. First-order thinker asks, is this company growing? Second-order thinker asks, how much growth is required to justify this multiple? If a company trades at 50 times earnings, it is not enough that earnings grow. They must grow faster than already implied, otherwise price contracts. Valuation is expectation compression. When expectations are extreme, asymmetry deteriorates. Second-order thinking also protects against narrative traps. When a compelling story dominates media, flows follow narrative. Narrative increases conviction. Conviction increases positioning. Positioning increases fragility. Second-order thinkers ask, what happens if narrative breaks? How exposed is capital to this belief? And markets often collapse not because fundamentals collapse first. They collapse because positioning becomes unstable. There's also a time dimension. First-order thinking is short-term. Second-order thinking integrates time. Example, a recession begins. First order, stocks down. Second order, are we late in the cycle? Has pessimism peaked? Are forward expectations already depressed? Markets bottom before news improves because expectations shift before reality. Second order thinking anticipates expectation change, not just data. Let's make this practical. When evaluating an idea, ask, what does consensus believe? What is embedded in price? What positioning exists? What would surprise the majority? What scenario would create forced repositioning? That is second-order analysis, but there is danger. Second-order thinking can become contrarian for its own sake. Being opposite consensus does not create edge. Being correct about mispricing does. Sometimes consensus is correct. The goal is not to disagree. It is to detect expectation asymmetry. Second-order thinking also ties back to expected value. If probability of success is high but expectations are extreme, payoff asymmetry shrinks. If probability is moderate but expectations are depressed, payoff asymmetry expands. And this is why best opportunities often feel uncomfortable. They require going against crowd psychology, not recklessly, but structurally. Here's the uncomfortable truth. Most investors think they are thinking independently, but they are reacting to the same headlines, watching the same data, listening to the same commentary. Second-order thinking requires stepping outside information flow, because information flow often amplifies consensus. If you remember three things from this video, first, markets price expectations, not reality. Second, crowd positioning creates fragility. Third, edge comes from understanding what others believe and how that belief is embedded in price. Being right about the future is not enough. You must be right relative to expectation. That is second-order thinking, and that is where real advantage begins.